Ram and some of my associates, we have recently formed an association of risk professionals offering consultancy. But just to give you a quick introduction about myself, I was in banking for almost 20 years, 3 of them with Citibank and 17 with Standard Chartered, which most of you would know in this region. I worked in this region between 2004 and 2010, but I've worked in various markets, including Singapore. Last one, I was in the Standard Chartered in the USA, heading their financial crime compliance for the trade finance and corporate finance business. Our topic for today, originally I think you had panelists who were supposed to come in and speak about consumer lending. And we thought, let's give you a little bit of, we've had topics around financial exclusion and et cetera. So one of the things which impacts everyone in the financial sector and in the fintech sector is regulations and how regulatory framework has changed. I wanted to use trade-based money laundering as an example, just to give you an idea of what are the challenges faced by the industry, et cetera. And there was a criticism, and rightly so, that especially the banks, they are not willing to take the next step. They exit entire portfolio of customers, de-risking as it's called, which is a complete opposite to financial inclusion. And why is it that that's happening, and what are the challenges being faced by financial institutions when they're doing it? If you look at the FATF definition from 2006, and this is a long presentation, so I'm just going to skip and focus on the key messages. If you look at the original definition from FATF, they had 3 ways in which you can do money laundering. 2 of them fell into what is the cash category, and the third one is trade-based money laundering. The cash was either using the financial systems or physical movement of goods or physical movement of money, which could even be like, in the Mexico, America, they sometimes make these gold-plated number plates, et cetera, put it on and just move it across the border, et cetera. And then you have, the credit cards, value cards, et cetera, moving. The most common one which is being used for money laundering is trade-based money laundering. But I would venture that there needs to be a change over here, because one of the new emerging is the cryptocurrencies and the new payment methods. Still, they are not officially recognized by FATF as one of the sources. Just to give you a quantum of a very conservative estimate is that every year close to 800 billion, but actually a more reflective value, which is most, at least my last organization, based on our estimates, $2.1 trillion of money laundering happens every year globally. Of that, 70% of $1.6 trillion goes through the financial systems. There are other, obviously, methods like hundi and other, et cetera, but I'm just talking about to the banking sector itself is $1.6 trillion. The biggest sector which gets impacted is the emerging markets, right? Most of the money goes out from the emerging markets into the real estate sector in UK, in Canada, in US, et cetera, or other safe havens where the money launderers want their money to be in those safe places. The proceeds of crime can come from corruption, tax evasion, and other illicit activities. Over the years, what has happened is that as cash and remittances have been subject to a lot more scrutiny, there has been a shift towards trade-based money laundering, because globally, the global trade of goods and services is about $21 trillion. And it's very easy to hide your money laundering in that, because it's, with so much value going through the system, it's much more easier to hide it over there. Just one thing I just wanted, I'm not going to go through as I said, this is a long presentation, but trade-based money laundering, you can do it in 3 ways. You can either manipulate the price, you can manipulate the quantity, or you can manipulate the quality. The price, what I mean is that something is worth, let's say, $10, you invoice it at $50. So that's basically over-invoicing. And depending on which direction you want to send the money. The quantity is that your documents say that you're sending 100 tons of goods, but actually what you're sending is 200 tons of goods. So you're actually over-shipping or under-shipping depending on which direction you want to send the value of money. And the third one is quality, which is the most difficult for most institutions to the same Louis Vuitton bag, original branded bag, which is for, let's say, $4,000, a knockoff would be, Chinese knockoff would be for $10. you sitting in a bank would receive an invoice that the Louis Vuitton bag or Montblanc pants are moving, but you have no way of knowing what's happening at the port authorities or whatever. What is the actual value which is moving? If you are whether you are a financial institution, whether you are a client, whether you are an exporter, importer, if you are operating in a global environment, there are multiple regulators and jurisdictions which you have to cater to. Just take the example of, suppose there is an Indian exporter who is selling something in Singapore and the underlying goods are invoiced in US dollars. So immediately it will have the Indian regulator, the Singapore regulator, and the US regulator, because the US dollar clearing has to happen in the United States. So these are some of the major regulators. The other one is that globally, out of the $100 of flows which happened, almost 80 to 90% of it still, Chinese yuan has gone up quite a bit, euro has gone up quite a bit, but still 80% of the global trade and wire transfers are still US dollar denominated. So even if you are not directly operating in the United States, if you are dealing in US dollars, and you're dealing through a correspondent bank, that correspondent bank has to adhere to some of these various regulators within the United States. And some of them, frankly, if you really, we can get into the nitty-gritties, but it would be a long discussion. Some of them have contradicting requirements on their own, and not necessarily send out the same message. They talk about risk-based approach, some talk about financial inclusion, but on the other hand, then there are other regulators, some of the aggressive ones like DFS, which nudge and force the banks to de-risk and exit a lot of their portfolio across, especially correspondent banking portfolio. Now here is where, to give you an example using trade-based money laundering, traditionally, if you were a bank operating in the trade finance space, what was expected from you from the regulator? All they wanted to use, if you see something, report it. And primarily the focus was on primarily drug trade, and that was it, that if you see something, you suspect something, report it. That is no longer the yardstick with which the financial institutions are being measured. Now you're supposed to be the eyes and ears of the regulator. And the definition of what trade-based money laundering or money laundering is has expanded significantly. It's about terrorist financing. It's about defense and dual use goods or military equipment, export controls, and it's now even in some jurisdiction it has even gone into transfer pricing. And to give you an example, and a lot of multinationals, there's a very thin line between tax planning and tax fraud. So just to give you an example, suppose a pharmaceutical is operating in India, as manufacturing in India, and the cost of production is $1. That drug is being sold in the US for $100. Now, if this company were to bill, and the tax rate in India is, let's say, 50%, and the tax rate in US is, let's say, corporate tax rate is 20%. Now, if that Indian company were to bill their American company at $2, they would have to declare a profit of $1 in India and have to pay 50% tax on it. On the other hand, if they sold that same good to a competitor, not to their own internal company, they would be selling it for $80. They would have to declare $79 as profit and pay 50% tax on it. So from Indian jurisdiction, they're saying, why are you treating various entities differently? And a lot of people have come out with ways to do it. They'll put a buying house or a marketing unit in Ireland where the corporate tax rate is 10% and paying far less. They'll sell, the Indian entity will sell it to the Irish for $2, and then Irish entity will sell to the US for $99. So only $1 profit is being booked in US and India respectively, and $98 is being booked in Ireland, and only $10 is being paid as profit. But that is something, again, as I said, things are moving. One of the major things in the trade space which has happened was that FCA, which is the lead, the primary regulator in the UK, in 2013 did a review of the trade-based money laundering standards for all the banks who were either headquartered in UK or had a significant business out of UK, which included basically all major US banks, UK banks, Asian banks who had offices or branches over there. And they came out with a damning report. This is a publicly available report. If you go, this is Banks Control of Financial Crime Risk and Trade Finance. It's available on the FCA side. It was accompanied by another paper which says good and bad practices in trade-based money laundering. Highly encourage it. Just go out to the FCA side and you will find this. So they basically said the banks have been focusing a lot on sanctions. They were not doing a lot on the trade-based money laundering, which triggered a lot of banks, including my last financial institution, where I was part of the team which totally revamped our trade-based money laundering program from scratch. These are some, you must have heard some of these horror stories about fines, which include the famous one, the BNP Paribas was the $8.9 billion. Now you would say that's a huge fine. Let me tell you something. These are even the regulatory fines have significantly changed. In the good old days, when the regulator came into fines, especially still in some of the subcontinental jurisdictions, if you make a mistake, the regulator will come up and say, for every mistake you're fined 100,000 rupees or something like that, right? That's not the case in US and Europe and everything. It's no longer, even the statutory fines have gone up significantly, but in actually what they come to the bank and say, listen, we believe we're going to prosecute you, not only you, but also your staff. You then enter into what is known as a deferred prosecution agreement and agree to not challenge any fines, and actually the fines have got no relation to the underlying regulations, etc. Like for example, in 2013, when RBS was fined $100 million, they were assessed to have facilitated $32 million worth of, this is not revenue, this is the volume which went through them. So they effectively paid $3 per dollar of money money laundering which happened through their accountants. If you had applied the same scale of justice of PNB Paribas, which was assessed to have facilitated $30 billion, they could have been fined as much as $90 billion. That means the bank would have just simply finished. So I'm just saying is that it's still, that $8.9 billion by that standards was relatively, they got quite cheaply. I'm just going to skip this because, as I said, this is a long presentation. Okay, now on the regulatory side, this is where I wanted to talk about the biggest challenges that a lot of financial institutions face in the regulatory space is that there is a lot of inconsistency in the legislation and regulatory requirements, right? Even across jurisdiction and within jurisdictions. So what's Department of Justice in the US, for example, what Department of Justice says versus what Fed says versus what DFS in New York says, there's a lot of different messages that came around. They talk about risk-based approach, but the reality is that when they actually clamp down on institutions, even if they pick up one or two instances, they extrapolate it to seem as if it's not, risk-based approach means that there will be something which will go through as long as there's not a malicious, deliberate attempt by the institution to facilitate that. The third thing is that biggest challenge, which Ram will subsequently get in a little more, it's about data confidentiality, and there have been stuff. Right now, if I am a bank which is processing a trade transaction, I have no way of verifying that the documents which are presented to me, there are some subscriptions like IMB, etc., but those are very limited and expensive. For me to verify that what documents have been presented to me are exactly what the port authority or the customs authority or somebody at the shipping forwarder has received. There are eventually the nirvana would be like a blockchain or some technology where you can anonymize some information so that commercial information is not leaked in terms of pricing, etc. But right now there is obviously, because of data confidentiality and commercial considerations, a lot of information is not shared. And the fourth biggest challenge faced by financial institutions is that we file thousands of suspicious activities or STRs as they're called in, I think, this region, which are filed every year. It's like going into a black hole, no feedback loop in terms of what, in terms of banks being able to identify and how many of them actually get prosecuted. I'm just going to skip this because as I said, if we had time, we could have gone. Oh, sorry. Let me hand it over to Ram. He'll then take you through some of the regulatory.
Thank you, Talal. I will start from the first speaker's quote, learn from history. Nikhil Sama. Thank you very much for that word. I was attending a cyber security crime conference in Gold Coast years ago. And there was a Chinese security specialist speaking in that conference. He actually said, if banks had either secretly or through some portal, if they shared all their loss stories of fraud, security vulnerability, IT vulnerabilities, and how they lost, the typology of how they lost those millions, by now, the industry would have saved up to 70% of future losses. They are all secretive because of the reputational loss deemed, which is correct actually, but there has to be a mechanism formed. Otherwise, we will continue to lose to those fraudsters and the attackers. And that is still happening, and no one is prepared to talk to each other. With that, let me go into the original topic we were supposed to talk about. If you were following the schedule, we were supposed to talk about the growing expectations from the regulators and the consequences of those growing regulatory expectations towards banks and their clients. Very certainly, the regulatory expectations are growing, but the legislative framework didn't change much from 2004 onwards. The 40 recommendations are still there, and the European Union recommendations, regulatory guidelines, they are not very much grown up, but they are trying to fill the gaps. But have we really adopted? But the regulatory expectation is growing not because there is a change in this, but they are trying to implement. They have been shifting from the learning stage to the serious implementation stage. They cannot be blamed for this, but are we living up to those expectations? When the expectations grow, there is a risk of losing either registration or license, and then our cost goes up, and then we try and establish from each other the traditional trust of each entity trusting each other when we do trade-based transactions have gone. So everyone is looking at every other institution with a suspicion. With those, our costs goes up, and we are trying to put less and less, more and more customers who are not profitable out of business in the shadow of de-risking and debanking. Is it really going to help? It is definitely not, because the regulatory authorities are not expecting the financial institutions to put them out. Rather, they want them to be carefully handled, closely monitored, and gather as much suspicious matter and report to them. And that is the best way to deal with this. My friend Nick would definitely agree with me when I say this. If you put them out, they will either go and look for another vulnerable operator, or they will go to a black market and start doing the same thing. Trade-based money laundering had been there this is the oldest form of money laundering, with the remittance-based money laundering. When a value in the Hawala system was put in the transfers mechanism, they usually are not straight away moving to the overseas jurisdiction. They go and fund it to either good or bad international trade activity. Usually it had been a bad activity because that should not come in the records. So when it surfaces, it at least touches two crimes which comes under our definition of predicate offenses. And the last being, as my colleague Talal spoke, the tax evasion is the last thing we are trying to tackle. where even though it is not of so much importance, if you look at the priority, we have to stop those child sex offenses which are really daunting us. But we have to understand every time a money laundering activity happens, one or other criminal activity is being boosted or given life to. People smuggling. There are many of these things which need to be stopped, and the expectation of the regulators, they are, as he said, they are asking the financial institutions to be their eyes and ears, if not the direct enforcement agency. If we have to be in that place, we need to be vigilant. Especially our focus is today trade-based money laundering. And the World Trade Organization and our mutual country-based trade agreements have brought the world very closer in terms of sharing the resources. But as the main component of this shift, when commodities move from one jurisdiction to another, the financial institutions, do we hold the information really necessary to facilitate that transaction? Sometimes, even the need, it starts from need to delivery and consumption. Some items, if we look into the application given to a banker for trade finance, it goes by common sense. If I say that I'm importing a pulse which is cultivated predominantly in India, if I am importing from US or Australia, is that a question to be asked? Why is this import really happening? Is there a need for this commodity being subjected to this trade? And then who orders? If someone who doesn't really need this item, if they are ordering for this item, are we really from my audit experience, let me tell you, the focus of the bankers from credit risk has not really shifted to the other risks involved in this activity. And all it takes is knowledge gathering and create internal and external knowledge base. And training. People need to really change verticals. Someone who is sitting traditionally for 20 years in trade finance has to really move away and give space to, because the new generation of compliance professionals bring new knowledge. Or either you train them and keep them. It's a good idea for us to shift this knowledge base and see how these new professionals are looking these into. And then, as he said, pricing. I have seen one in one of those audits, how much an aluminum foil we use in the kitchen, it costs 80 cents. But 3 containers of aluminum foil should not be costing $3 million. If it is so, then someone needs to really get up and see why it is so. From end to end, the information provided by freight forwarders and the ports themselves, they need to know what is really happening. One intelligent importer who sells shoes to retail entities went to China. He sourced shoes full of 2 containers and sent, I'm just giving an example of the ports, Nick. He sent all the left pairs to Perth and the right pairs to Sydney. And then he didn't clear it. Because of his failure, this came to auction. And he got his proxies to, because no one would buy this, right? Who would buy only left shoes? He would buy and bring them together. He knows the codes. They will quickly make them into pairs and sell at premium rates in the market. So from end to end, knowledge is very important. And sharing information among the verticals. If they are not speaking together, we may not be able to solve these puzzles. And publishing typologies is one thing. We can actually publish industry-based typologies. They had been very, very helpful, because if you don't really help each other, especially by taking the labels off, without really divulging the investigative information, if we share those information among ourselves, even within the same bank's branches, and then articulating training within those changing risk, new and emerging risks, that would really be a very effective way of handling this. Exiting any relationship is definitely not a solution. So growing expectations will be there, they will continue to grow, but this also presents for the attendees here a lot of opportunity to work on bringing this information. There are many ideas where we can bring this information together in blockchains and present it to the bankers, which would actually, they would be paying for what they are getting. But at the end of the day, this solves the issue of trade-based money laundering. We would only try to reduce these. As long as the trades happen, this would also happen, but newer typologies would surface, and we have to learn to articulate and handle them. Thank you very much.
Just a question for the audience. To give you an idea of how various stakeholders, banks obviously are under pressure to do their bit. Guess how many containers coming into the United States, for example, or how many containers going out of United States are actually physically inspected? Anyone want to take a stab at that? Sorry? That's correct. 3% coming in, 1% going out. So the port authorities and the customs authority check less than 3 out of 100 containers going out. Well, so that's why. Okay, another question which might not be politically correct in this region, but this is based on International Maritime Bureau. Guess which port in the world is responsible for 70% tampered and misrepresented bills of lading? 70% of the global volume, which are actually caught by the various banks, etc. There's just one port. So when you're an exporter, you normally present, if you send it through a ship, you will present what is known as a bills of lading, which is the ownership document. On the other end, somebody has to present it to claim the goods. Plus, it is accompanied by a certificate of origin issued by the Chamber of Commerce in the country that the goods are originated from that country. Guess which port is responsible for 70% of it? Anyone wants to take a stab?
I don't think people want to get into trouble.
I think the silence is so. I think so. These obviously the proximity to some of the sanctioned countries nearby makes it a lot of challenging. But that's one of the challenges that we face when we receive BLs from this jurisdiction. It becomes a bit of a challenge when we are looking at them, because a lot of them, even where they're bona fide, you look at them very suspiciously. So, anyways.
Banks are very busy focusing on, again, I believe from my banking experience, are very busy focusing on the small fish, thousands of transactions going here, or using your personal account to do your business transactions, for example, which is really not criminal, it could be ethically wrong but not criminal. And as a result, millions and millions of dollars are passing through by the big guys, right? And yes, banks are trying to gear up their systems and their processes and the governance framework and all of that, but most banks wake up only when they get a regulatory fine. So what would be your suggestion to the financial institutions on the next step where they could actually focus on the big fish rather than harassing the small ones?
I think there is already I think it's working, sorry. I think there is already this understanding that that is the case. The banks have moved away from focusing on the smaller ones. In fact, I chair the BAF Trade Compliance Committee, for example, right? So our focus has been shifting towards industry advocacy. Globally, right now, just to give you an example, like, so you're saying that our focus is on wrong. Globally, out of the global trade which happens, 10% of it happens through documentary trade. 90% open through open account. In open account, where unless the bank is, it's like factoring or some other product or invoice financing, unless the bank is involved in the underlying transaction, financing of the transaction, there are only 5 data points which are available to banks, which is who's sending the money, what's his address, who's receiving the money, what's his address, and maybe a one line saying this is the purpose of payment. As opposed to in documentary trade where both the exporter's bank as well as the importer's bank get to see the underlying documents, the BL, etc. If I was a fraudster or a money launderer, would I do documentary trade or would I do open account trade? But if you look at the bank's effort in terms of identifying trade-based money laundering, all their focusing was on documentary trade, which what it does is it impacts the bona fide customers because their transactions get stopped because of false alert, false positives, etc. And on the open account, we are right now putting it together with the wire transfers without understanding that the wire transfers can be from as simple as making a payment for your daughter's school fee or college fee, as opposed to also buying Walmart making a huge $1 million procurement of jeans, etc., right? So on that, unfortunately, the banks have not been focusing. So as an industry, the BAFT, ICC, Wolfsburg have said to the regulators that we need to move away from spending so much effort on documentary trade, which is frankly much less riskier, and moving towards open account, and bringing in other stakeholders like, for example, the shipping companies, the port authorities, the customs authorities, being able to share that data with each other. And one of the ways you could do is potentially using technologies like blockchain, etc., whereby, let's suppose I receive a bills of lading, without having to go into who's selling and who's buying and what is the per unit price, because that would impact the commercial confidentiality.